So you want to invest. That's fantastic. It means you're thinking about your future, about building wealth, and about making your money work for you instead of the other way around. Investing can be a powerful tool, but it's crucial to approach it the right way. Now, you've seen the headlines, heard the stories, the overnight successes, the incredible returns, and you're ready to make your money work for you. You're tired of seeing your savings just sit there, slowly losing value to inflation. You want to be proactive, to grow your wealth, and to secure your financial future. The excitement is great, but it can also be a trap. It's easy to get caught up in the hype and make impulsive decisions that you'll later regret. Too many people jump in without a plan, without knowledge, chasing hot stocks or crypto, following the latest trends and tips from social media, while their financial foundation is crumbling. They might have high interest debt, no emergency savings, or be living paycheck to paycheck. It's like building a skyscraper on sand, impressive for a moment, but destined to collapse. A sudden market downturn, an unexpected expense, and the whole thing comes crashing down. The real first step to investing isn't picking stocks. It's not about finding the next big thing or trying to get rich quick. It's getting your financial house in order. It's about building a solid base upon which you can grow your investments safely and sustainably. Think of it as your pre-flight checklist. Before a pilot takes off, they don't just jump in and start the engines. They check every system to avoid disaster. They ensure the plane is safe, the fuel is sufficient, and the weather is clear. Investing is your flight, your journey towards financial freedom, and your financial prep is your checklist. It's what ensures a smooth and successful journey. When turbulence hits, and it will, the market will fluctuate. Unexpected expenses will arise. You want to be ready, not scrambling for an emergency landing. You want to be able to weather the storm and stay on course. This guide is your pre-flight checklist. It will walk you through the essential steps to prepare your finances for investing. We'll focus on the unsexy but crucial groundwork, the things that might not be exciting but are absolutely necessary for long-term success. Debt. Managing and eliminating high-interest debt is a top priority. Savings. Building an emergency fund to protect you from unexpected expenses. Goals. Defining your financial goals and creating a roadmap to achieve them. And mindset. Developing a healthy relationship with money in a long-term perspective. These steps separate gamblers from real investors.
Your money's working while you do less. Stay lazy, let your money do the rest. The lazy investor.
You can't treat investing like a game of chance. It is a must that you approach it with knowledge, discipline, and a strategic plan. Build your foundation brick by brick, step by step, and you'll invest with confidence in a good, solid plan. You'll be prepared for the ups and downs of the market, and you'll be well on your way to achieving your financial goals. Hi, I'm Paul Cox, the Lazy Investor. Welcome back to the channel. Let's get started. Let's build that foundation and set you up for investment success. If you're new here, you're still here, so you must be interested in investing. If you are an entrepreneur, if you want to be an entrepreneur, if you want to know all about investing, stocks, bonds, crypto, real estate, metals, and technology, if you want to learn how to compound your money into real wealth, if you want to retire early, if you want to build wealth now and secure financial freedom in the future, then The Lazy Investor is the channel for you. Lock it in, subscribe, hit like, click all the things. Okay, let's set you up for investment success. Before you invest a single dollar, let's talk about high-interest debt, especially credit cards. Hopefully, you can skip this bit. But if you have credit debt, especially the high-interest kind, listen up. The average credit card charges 20% interest or more. The stock market might return 8 to 10% in a good year. Paying 20% while hoping to earn 10% is a losing game. High-interest debt is a wealth destroyer, a tax on your past that cripples your future. Every dollar in interest is a dollar you can't invest or use for your goals. Carrying this debt is like running a marathon with a ball and chain. Rule number 1, paying off high interest debt is your best investment. It's a guaranteed, risk-free return. Better than any stock or real estate deal. Slay this debt dragon before you do anything else. Ready to tackle your debt? Here's how. List every debt amount, minimum payment, and interest rate. Choose your strategy. Either debt snowball, smallest balance first for quick wins, or debt avalanche, highest interest first for maximum savings. Pick the method you'll stick with. Consistency is key. Automate minimum payments for all debts. Set up an extra automatic payment toward your target debt. Automation keeps you on track even when motivation fades. Find extra money, cut unnecessary spending, sell unused items, or boost your income. Every extra dollar is a weapon against your debt. Combine a focused plan with aggressive saving and earning. Watch your debt melt away faster than you ever thought possible. The key steps: get started, automate, and don't stop until it's gone. You've got this. With high-interest debt under control, you've successfully navigated a crucial first step towards financial freedom. Now it's time to shift our focus to building something that will protect you from life's unexpected curveballs. It's time to build your emergency fund. This is a critical component of a solid financial plan. Think of it as your financial fortress, a safeguard against unforeseen circumstances. This is cash readily accessible and held in a separate savings account, specifically earmarked for those moments when life throws you a financial curveball. It's for true emergencies only. This isn't your vacation fund or your want fund. It's your need fund. Think job loss, a situation no one wants to face, but one we must be prepared for. Unexpected car repairs, those always seem to happen at the worst possible time, or unforeseen medical bills, which can quickly derail even the most carefully laid financial plans. Why build this emergency fund before investing? It's a valid question because life happens and it rarely sends a warning. Unexpected expenses are a part of life, and you don't want to be forced to sell investments at a loss when an emergency strikes. Selling low defeats the purpose of investing in the first place. Aim to save 3 to 6 months of essential expenses. This will provide a comfortable cushion. Consider your essential housing costs, the money you spend on food, and essential utilities to keep your home running. Don't forget transportation costs to get to work or other essential places. And of course, insurance premiums to protect yourself and your assets. And factor in the minimum debt payments required to keep your accounts in good standing. Carefully calculate your bare bones monthly needs. What is the absolute minimum you need to survive each month? Then multiply that number by 3, 6, depending on your individual circumstances. If you have a stable job with a reliable income, 3 months worth of expenses may be sufficient. However, if you're a freelancer with fluctuating income, or if you have dependents relying on you, aiming for 6 months is a much safer bet. Open a high-yield savings account specifically for this fund. Look for the best interest rates you can find to help your money grow faster. Name it something like Emergency Fund Do Not Touch. Make it clear to yourself that this money is off limits unless a true emergency arises. Automate transfers every payday. Set it and forget it, making saving a seamless part of your routine. Even if it's just $50 to start, the important thing is to get the ball rolling and build momentum. Treat it like a non-negotiable bill to your future self. Prioritize it just as you would any other essential expense. And as you pay off debt or receive raises, make it a point to increase your savings contributions. Building this fund gives you invaluable peace of mind, knowing you're prepared for whatever life may throw your way. And it allows you to invest with confidence, knowing you won't have to liquidate your assets at the wrong time. So build your financial fortress brick by brick before you venture into the world of investing. It's the foundation for long-term financial success. With your foundation set, it's time to define your goals. Why are you investing? What does your rich life look like? Goals give your money a purpose and keep you motivated. Break them down: short term, 1 to 3 years, medium term, 5 to 10 years, and long term, 10 plus years. Be very specific. For example, not just, I want to buy a house. Be very specific. I want to save $40,000 for a house down payment in 7 years. Your timeline shapes your investment strategy. Short-term money stays safe and liquid. Think high-yield savings, not stocks. Long-term goals like retirement can handle more risk and market ups and downs. Match your investment to your timeline. Intelligent investing is using the right tool for the right job. Define your goals and let them guide every decision. That's how you build a rich life. Now let's talk about risk tolerance. How much market roller coaster can you handle? Your timeline matters. The longer you have, the more risk you can take. Financial stability helps too. A solid emergency fund lets you weather storms. But the biggest factor is your emotional temperament. If a 20% drop makes you panic, you need a more conservative portfolio. If you can shrug it off, you can afford more risk. The right balance lets you sleep at night and stay invested for the long haul. Know yourself and build a portfolio you can stick with. Almost ready to invest? You've done your research, you've set your goals, and you're eager to see your money grow. That's fantastic. But before you take that leap, there are just 3 final steps to ensure you're setting yourself up for success. These steps are crucial for building a solid foundation for your investment journey. First, check your credit report for any errors. Make sure everything is accurate and up to date. And while you're at it, familiarize yourself with your credit score. Understanding your credit worthiness is key. Good credit saves you money. It's that simple. A strong credit score translates to better interest rates on loans, lower insurance premiums, and a host of other financial benefits. Second, learn the basics of investing. You don't need to become a Wall Street guru overnight, but a basic understanding is essential. Start with stocks. Understand what they are and how they work. Then, explore bonds. Learn about their role in a balanced portfolio. Delve into mutual funds, discover how they offer diversification, and investigate ETFs. See how they can provide cost-effective exposure to various markets. And The Lazy Investor has videos on many of these topics, so subscribe so you can keep updated on all this stuff right here on this channel. Grasp the importance of diversification and understand the principles of asset allocation. Knowing how to spread your investments across different asset classes is crucial for managing risk and maximizing returns. You don't need to be an expert to get started. Just know enough to avoid being intimidated or misled by complex jargon or overly aggressive sales tactics. Third, start small. Don't feel pressured to make a huge investment right away. You don't need thousands of dollars to begin building your investment portfolio. Starting with just $25 or $50 a month is perfectly acceptable and often the best way to begin. The primary goal at this stage is to build the habit of investing consistently. It's a marathon, not a sprint. You're aiming for long-term growth, not to get rich overnight. To make it even easier, automate your first investment. Set up a recurring transfer so it happens automatically every month, regardless of what else is going on in your life. This will significantly lower the emotional stakes involved in investing and allow you to get comfortable and familiar with the entire investment process without feeling overwhelmed. Taking these preliminary steps will set you up for a much smoother and more successful investing journey. So, remember to learn the basics of investing and start small with an automated plan. With these steps complete, you're truly ready for liftoff. Let's go and begin your investment journey. You've finished your checklist. Now take action. Don't fall into analysis paralysis. Waiting costs you more than you think. Compound interest fuel is time. Every day you wait, you lose potential growth. Start now, even with a small amount. For most new investors, open an account at a low-cost brokerage like Vanguard, Fidelity, or Schwab. Invest in a low-cost, diversified index fund or a target date retirement fund. Don't overcomplicate it. Simple is powerful. Automate your monthly transfers. This is dollar cost averaging. Automation removes emotion and builds wealth quietly in the background. Investing should be boring, and that's a good thing. Open your account, automate your investment, and let time do the work. Take the leap. Your future self will thank you. Let's recap with your final pre-investment checklist. 1. High interest debt is under control. 2. Emergency fund is in place. 3. Your financial goals are specific and written down. 4. You know your timelines. What's for short-term savings? What's for long-term investing? 5. You've honestly assessed your risk tolerance. 6. You've checked your credit report and know your score. 7. You understand the basics. Stocks, bonds, mutual funds, ETFs. 8. You have a start small plan and are ready to commit. 9. You've chosen your account and first investment. 10. You're set to automate monthly transfers. Don't just watch this stuff. Do it. This is your moment. Take control and start building your rich life. Nobody's going to build your wealth, so you've got to do it yourself. Stay lazy, let your money do all the work, and I will see you on the next video. Watch this one next. I'll see you over there. I'm out.